Is an accommodative Fed bullish for the stock market? That seems like an especially relevant question right now, though the correct answer should always be relevant to investors. And this chart helps us see that, in fact, there's more than one way to answer the question. So, this price line is the S&P 500 from the late 1990s through the present. Beneath it, in blue, we have the federal funds target rate set by the U.S. Federal Reserve. For emphasis, we'll show it in several increments along the way. First is this period, the dot-com peak and subsequent bust and bear market of the early 2000s. In response, the Fed cut rates 13 times, down to just below 1%. That was accommodative, yet as you can see, the stock market kept falling anyway, 51% from peak to trough. In the mid-2000s, the market turned upward, rates followed later, and even after rates stopped following, the market kept going up. Then came the market peak in 2007. As the S&P spiraled down, the Fed followed with 10 rate cuts in 2 years, this time to virtually zero. That was accommodative. But the stock market kept falling anyway, 58% from peak to trough. Afterward, the central bank stayed at near zero until late 2015. The market had been going up when the Fed began to raise rates, and it kept going up in 2016, 2017, and 2018. One can say that was not accommodative, yet the evidence says the market did not care. During those 9 rate increases, the S&P 500 climbed 57%, which brings us to 2019 and recent headlines saying that the Fed's pause on further rate hikes is accommodative and bullish for stocks. Really? The Fed was accommodative down to 1% and lower during 2 of the biggest bear markets in 80 years. It was not accommodative when the S&P 500 went on a 57% bullish tear. Is an accommodative Fed bullish for the stock market? Quite the contrary. Wall Street and too many investors can stick with their faith in the Fed's ability to manipulate the stock market higher. We'll stick to our historical analysis and bearish forecast. Stay tuned.